The Occupy movement, the continuing Arab uprisings and the general austerity demonstrations in Europe has been at the order of the day throughout 2011. This has significantly influenced investor opinion, with some investors deciding that markets are best left alone. Tonight, we'll be exploring the US markets and how returns fared during 2011. Gentlemen, welcome to the program. Great to have you on the show. Let's start off with you, Kobie. We're specifically taking a look at the S&P 500 index, and we know that it actually underperformed relative to what we saw in South Africa over 2011.
Yeah, I mean, Eleni, what we did was we looked at the South African market last week, and we looked at earnings and returns and dividend flow in the South African market. And what we're going to do today is we're going to be looking at the S&P 500 and looking at how those returns over the last half a century has actually stacked up. So if you have a look at your screen, just briefly, you'll see a chart which you'll be familiar with. It's something that you would have seen last week if you've seen the show last week. And it again just shows the kind of investment performance you've seen for the South African market in blue, the S&P 500 in maroon, the FTSE 100, which is the UK, in green, and then Hong Kong in purple. All of those returns that you're seeing on screen there is based upon a rebase to 100, which means that you've invested 100 of a specific currency in the beginning of the period. So if you're in Hong Kong, you would have invested Hong Kong dollars, and in this case for the S&P 500, you would have invested US dollars for the S&P 500. The total return there for the S&P 500, you can see where the pointer is there, is about 1.6% for the whole year. Slightly worse than the South African market, which was up at 2.6, but certainly a lot better than what you've seen, for instance, in places in other areas in Europe, for the FTSE 100 and also in Asia.
Why is that? I mean, does it have to do with the earnings potential? And we have seen better earnings coming through on the S&P, Kobie.
Yeah, I mean, I think it's got to do with the earnings potential, number one. Yeah. And number two, you know, the subprime crisis, as we've kind of seen in the end of the subprime crisis, although we know there's a sovereign crisis potentially looming in the US, I don't think it's to the degree that we've seen it playing out in Europe. And that obviously has influenced some of the return numbers that you've seen over there.
Roland, let's take a look at volatility. And when you see how volatility fared over 2011, it wasn't as dramatic as what we saw in 2009. 2010 was far better. Last year was also a bit better. But what kind of views does this give us when you look at volatility over the period?
Well, what is interesting is that volatility has come off dramatically from the subprime crisis levels. In 2011, we saw volatilities in the US drop from about 25% to about 15%, 17%. So volatility has come off. What that creates is the perception that equities are now normalizing and that we should perhaps reconsider investing in them. But what is missed by a lot of investors is that you should look at relative volatility. So what have equities done relative to bonds? And what is really interesting is that prior to the subprime crisis, equities were 1.5 times more volatile than bonds. So equities are always more volatile than bonds, but they were much less volatile relative to bonds prior to the subprime crisis. And you got high returns prior to the subprime crisis for low risk, which was like a free lunch. What's happening now is that in the US, equities are 4 times more volatile than bonds currently. So volatility relative to bonds has gone up, although the overall level of volatility in the market has come off. So what that is telling us now is we're getting low returns from equities in the US for very high relative risk, which is the opposite. It's an expensive lunch. Yeah. And this is keeping people away from equities because the relative volatility to other asset classes is at record high levels still.
Okay. Which is ironic, by the way, because if we've got some defaults that happen in the bond space because of the debt burden, then you're going to see the volatility in bonds picking up. Yeah,
exactly.
But I mean, obviously, volatility is a function of the fact that we see a lot of traders coming into the markets on a day-to-day basis, as opposed to people holding long positions.
This is an asset allocation argument, and I think what people are missing is they're saying stocks are cheaper now because the markets have come off over the last few years or have gone nowhere. So on a relative basis, maybe compared to history, stocks are cheap. But what they're missing is that the risk appetite is not back yet in the market. So investors, because of this high volatility relative to other asset classes is still so high, people are not wanting those equities because you're getting low returns for high risk. Why would you want more equities?
But you know about this, and we've spoken about this so often with regards to the Dow Jones and the S&P. If you look at it over 10 years, hasn't done very much. I mean, you look at the JSE All Share, for example, we've done fantastically well over a 10-year period. It seems that this conversation is ongoing with regards to the value that can be had and the returns that you can find in the US markets.
Yeah, I mean, I think on the back end of that, Eleni, let's have a look at some returns for the S&P 500. We're going to look at it in exactly the same way as what we did last week. Just if you look at your screen over there, you'll see that's what's called a frequency chart. And if I'm saying it wrong, then Roland can help me just now because he is the quant on the show. But if you have a look there, I've bucketed the various returns for the various annual return periods. And then I've basically just showed you those in calendar years. And you can see that if you remember the picture for South Africa, this picture is looking a lot different. Just to quickly show you quickly, if you want to see, if you have a look over your screen over here, in 1975 and 1995, markets were up in both those years by 30 and 40%. So let me go and highlight for you what the returns look like after, over the last 4 years. If you have a look at your screen over there, you'll see returns from 2008, and you can see their returns are below minus 40% for that calendar year. You've literally rewritten the half a century textbook as far as how negative markets can be on the S&P 500. 2009, markets up by 20 to 30. 2010 by 10 and 20%. And if you have a look at 2011 there's the return number in there for 2011. I mean, somewhere in the middle, it's not that bad. The interesting thing to note is that when this market does well, it does in the order of 20 to 30%. Whereas if the South African market does well, it does in the order of 40% and 60%. So you certainly got a lot more returns out of the South African market than you did out of the US market. And then the interesting thing is if you have a look at that 20 to 30% bracket, look how many of those time periods are actually in the 90s. Let me highlight them for you. Tons of those time periods are actually in the 1990s, with 1995 being 30 to 40% higher. And then let me fit a distribution curve to those, completely skewed. You're not getting those massively positive numbers that you get in the South African market, and then you're getting a whole bunch of numbers that are actually quite a negative space.
And Roland, I mean, if you look at these numbers closely, between 0 and 10% or 10% returns, around 18 out of the 50 years. Which we know there's pretty much subdued returns that we've seen. But out of the 30 years, it has been 30 years out of the 50 years have been above that 0%. So that's what we should really be focusing on. Are you happy with these returns?
You've got to take into account that developed markets, what we're talking about here is a developed market and emerging market kind of effect. So developed markets have been growing slower than emerging markets. South Africa hasn't been growing fantastically, but emerging markets, which South Africa is part of that universe and probably benefits at the margin, has as a country, emerging markets have done quite well. And inflation has been much lower in those markets. So you tend to have lower returns when inflation and growth is lower. And that's why emerging markets are a high beta play. They give you much higher returns in good times and much worse returns in bad times. And that's what's coming through in that graph.
Kirby, when you look at the returns overall and even just the performance that we've been seeing, what is the prognosis then with regards to the investment philosophy that you should be embarking on the S&P 500, given the fact that returns are not as fantastic as we see on the emerging market space? Should you be stock picking and looking at those multinational companies? I mean, we keep talking about this. Is that what's going to offer the great returns because the earnings are going to be far higher on specific stocks?
You see, and this is now where you've got to be careful in asset management. If you do a regression analysis and you just look back at these return numbers, you'll see return numbers that are potentially not great. You're seeing return numbers where you could have done far better in the emerging market set. And I mean, I'm thinking about South Africa there, but there's many other emerging markets that are certainly in that space. But that invariably could be a great opportunity as well. I mean, the PE at the moment on the S&P 500 is 14 times earnings. The last time around, you could have bought the market at 14 times earnings was back in 1998. Which kind of now shows you that this market has come from a very high point from a valuation perspective and has been cooling and cooling and cooling. But if we had to juxtapose that relative to earnings, potentially over the last 10 years, some very good companies have just continuously made money and created earnings and dividend flow for their investors. So there's the opportunity, and you've got to be contra-cycle to kind of see those things kind of playing themselves out.
I agree with that. I think there are. Valuations are important, but there are three things that drive equity markets. You've got earnings growth, which is a long-term kind of generation by the economy in terms of output or profit. Valuations are critical, but risk appetite is actually what is not there at the moment, and that's the catalyst that we're waiting for to really push those returns in the US
into, in a sense, with regards to the investor community as well. I think
it's as I say, would you buy US equities where you are getting low growth compared to, and Europe's also low growth, or would you rather go into emerging markets which on a risk-adjusted basis are giving you a much more attractive kind of return?
Maybe
and I think
a US company that has its tentacles in emerging markets. Who knows?
Absolutely.
Let's have a look at earnings. If you look at your screen over there, you'll see the same picture what we had for the returns on the S&P 500, and you can see the earnings for the S&P 500. Most of the earnings numbers kind of happen in this space over here, which was earnings up by 10 and 20%. There is incidence of earnings that increase by 20 and 30%, and very few instances of 30 and 40%, but certainly not a situation that you're seeing in South Africa and what you've seen in South Africa. Let me highlight for you the last 4 years. There you can see 2008 again, earnings dropping by below 40%. And then interesting enough, if you have a look at the other side of the screen, you'll see that in 2009, earnings reverted strongly by more than 100%. Again, rewriting the textbooks as far as the half a century numbers are concerned. And I mean, the interesting thing for me here is that is what is driving sentiment at the moment. That is the kind of the story around sentiment and how negative sentiment is at the moment, because we've rewritten the textbooks and people are you've kind of shake their cages and they're kind of saying, no, am I going to expect more? Can I expect more of these negative kind of earnings numbers that'll then drive returns?
Well, let's juxtapose, I mean, some of the earnings, the strongest earnings or returns that we saw were predominantly, as you mentioned, in the 90s, that were around 10% and higher. And when you look at the earnings front, a lot of the 90s experienced only 10% earnings over that period. So, what kind of correlation do you draw?
Yeah, I mean, it's interesting that you mentioned that. I mean, have a look at your screen over there. There we highlight again the earnings picture for the 1990s. Now, remember the late 1990s, if you just, the graphs that we showed you just now, showed you that actually returns were very, very robust, but that earnings numbers continue to actually come back. And that took the total price to earnings ratio for the market in 1995 from 16 times earnings all the way up to 32 times earnings in 1998, before the market started cooling down again. And that's an important lesson. Returns and earnings aren't necessarily always correlated. The one lags the other one, and sentiment drives the one and not necessarily returns. I mean, returns are generally far more widely distributed than what earnings are. Earnings are far more narrowly distributed.
Okay, so we know that we always talk about how efficient markets are, but this is a question for you, Roland. Do you think that the markets are pricing in the right earnings at the right time? Do you think we're doing it effectively?
I think long-term valuations are currently pretty much around the average. So the market in terms of valuation is pretty fairly priced. And I guess that's true in the US and in South Africa, less so in Europe. But in terms of the looking forward, I think what you are seeing in the US are certainly signs of earnings growth coming through. And that's going to demand a higher valuation as people accept that. It's just the risk appetite element that is still missing. People are still scared of equities, irrespective of what interest rates are doing and what earnings are doing. But you're seeing strong housing numbers, you're seeing manufacturing improving, unemployment is decreasing in the US. So the economics are looking good. But we got to wait for people to say, I want equities, rather than I want just good traditional old growth.
And I mean, if that happens, okay, that happens in waves and leaps and bounds. Just before we go to break, I mean, just have a look quickly at your screen there. There's a distribution curve that we fit to earnings on the S&P 500. And if we take some of those single data points out of the consideration, because I mean, earnings don't generally go up by over 100% like we had in 2009. You see the distribution curve and how skewed that is also for the S&P 500.
On that note, we're going to go to a very short commercial break, and when we return, we take a look into the S&P 500's performance over 2011 and zone in on dividends. Don't go anywhere.